Hello, my name is Grayson Massey. Originally from Utah, I'm a senior this year at Westminster College, pursuing a double major in international business and finance.
My name is Kachar Bonarth. I grew up in Cambodia and I'm currently a senior in finance and accounting.
My name is Cameron Ovalle. I grew up in West Jordan, Utah. I just recently graduated with my MBA from Westminster College.
My name is Oscar Vollo. I'm born and raised in Norway. I'm a junior majoring in finance.
My name is Michael von Balmos and I grew up in Switzerland. Earlier this year in May, I graduated with my bachelor's degree in finance. We're representing the Gore School of Business at Westminster College for this Business Valuation Challenge of 2018. In this particular case, we're acting as representatives of Investment Bankers LLC. We're responding to a project endeavor from John Doe, a board member of Chinos. And keep in mind, all of this is happening in 2014. Welcome to our analysis of the $20 per stock offer from ATL Capital for Chinos. Earlier this year in 2014, John Doe, a board member of Chinos, has sought our advice on an unwanted takeover advance from ATL Capital. We have analyzed the options and prepared our proposal. First, we're going to start with a position overview of the business. Second, we're going to take a top-down approach and walk from a macroeconomic overview down to the details of Chinos' financials and our valuation approaches. In the end, we will reveal our proposal for Chinos. Let's get right to it. Chinos is a men's casual retailer operating in the United States. Therefore, our industry analysis is based off the men's casual retail industry. We also consider apparel in general when researching comparable companies for the purpose of our proposal. The CEO, Juantia Martinez, is reaching retirement age. However, she's lobbying the board to amend the retirement policy for her to remain CEO. She took Chinos public and wants to leave with Chinos being left in good hands. Max Martinez is the CEO's 30-year-old son and is currently the COO of the company. His mother perceives Max as her natural successor as CEO. Chinos has entered a new partnership with Southeast, the legendary rapper, and will introduce a new line of leather jogging shorts designed by him. This initiative was spearheaded by Max. Chinos currently has 10 million shares outstanding. Its stock price has been languishing lately and is now trading at $12 per share. Max is eyeing the acquisition of Boots Electric, a shoe store based in Canada. However, hardly any details have been given to the board. Max believes EBITDA will grow to $35 million due to the acquisition of Boots Electric. Furthermore, Max believes the new partnership with Southeast and the acquisition will raise brand awareness that will translate to more customers. Lastly, margins are expected to increase due to the acquisition. We will now move to the economic outlook for the year 2014, industry forecast, and what this means for Chinos.
GDP growth is forecasted to increase since the Great Recession of 2008, with recent data supporting sustained growth throughout 2014. In the graph shown, we can see the actual GDP forecasts provided by the Federal Reserve Bank of San Francisco. GDP growth is a key driver for industry growth. What this means for Chinos is that the company's growth and revenues are expected to grow in tandem with economic forecasts. Indicators helping to forecast this growth are the recovery of the housing market, rebounding consumer and government spending, and the relaxation of federal fiscal policies. Unemployment has steadily decreased to 7% and is expected to decrease gradually over the next several years. Consumer attitudes are also shifting, as they see prices falling, an increase in their discretionary income, and a recovering economy. Per capita disposable income translates to an increase in discretionary spending, which will expand Chinos' bottom line as more consumers find themselves with the means to buy highly elastic goods, such as men's casual wear. Falling unemployment helps drive demand, as more men enter the workforce and therefore require more professional and casual wear. This complements well the increase in disposable income, which gives them the means to do so. The men's clothing and retail industry is forecasted to grow by 3.1% annually into 2018. This comes after a sharp decline from 2009 to 2014, with the industry contracting by 0.3% annually, as seen on the left-hand side of the graph. Because of the expected macroeconomic outlook previously mentioned, analysts are forecasting a sharp industry turnaround. We will now move into the valuation portion of our presentation. For the following valuation approaches, we are using management's projection from Chino's income statement and balance sheet. We have Chino's projection as a line graph with the years represented by the x-axis and dollar value in thousands represented by the y-axis. On the left side of the graph, we show Chino's actuals and estimates for the years 2011 through 2013, then the projections for the next 6 years from 2014 to 2019. As you can see, Chino's has high expectations of a turnaround. Its revenue projections are estimated to grow to about $750 million in 2019 at a rate of 4 to 6% per year from 2014 to 2019. Despite the historical decline in revenue, we assume management has incorporated into its plans to increase brand awareness, sales, and margins as discussed earlier. For the expense chart, we see Chino's expenses are projected to grow at a rate of roughly 4% per year from $560 million in 2014 to $697 million in 2019. The expenses are projected to grow at a slower pace than the revenue, indicating better margins. This chart shows EBITDA from the actuals into the future forecast. As shown on the chart, EBITDA forecasts are increasing from $35 million in 2014, increasing through 2017, and leveling out from 2018 to 2019 to the tune of roughly $62 million. Operating margins are also projected to increase from 2.4% in 2013, reaching its peak in 2017, and then levels out to about 7.1% in 2019. On average, the rate is increasing at approximately 5% annually.
To calculate the projected free cash flows, we adjusted EBIT for taxes and added depreciation back in. We also subtracted change in net working capital and capital expenditures. As management has projected growth in operating profit, with expenditures growing at a slower pace, free cash flow is driven to increase from $7 million in 2013 to $33 million in 2019. We use a traditional discounted cash flow method to value Chino's at the beginning of 2014. And we use a provided comparable company weighted cost of capital of 12.21% as the assumed discount rate for the cash flows. We have also calculated cost of equity using a build-up method and a capital asset pricing model. In the next slides, we will further weigh the cost of equity with the cost of debt to get to the average cost of capital to justify using the comparable WACC. First, let's look at the two cost of equity calculations. The inputs for the build-up method are derived from a risk-free rate of a 20-year Treasury bill, an equity risk-free premium of 5%, an industry risk rate of 1%, and a size premium of 6%. The CAPM method uses the same risk-free rate and has a beta of 1.2 and a market return of 12.15%. The final values for cost of equity using the build-up method is 16.03% and using CAPM is 13.78%. To further calculate the weighted average cost of capital, we incorporate the cost of debt. We take into account Chino's value of debt at 27% of the business, cost of debt at 7.39%, and a tax rate of 34%. This gives us the following discount rates. For the build-up method, we calculate a WACC of 13%, and for the CAPM method, we calculated WACC to be 11.34%. To estimate Chino's enterprise value, we calculated the present value of the discounted cash flows. For the discount rate, we used the provided comparable company WACC of 12.21%. Furthermore, we added the calculated terminal value derived from the expected industry growth rate of 3.1%. The estimated enterprise value is close to $285 million using the assumed growth rates and discount rates. Here we show a range that shows the calculated enterprise values derived from our three different discount rates: the build-up method, comparable, and CAPM weighted cost of capital, and the three growth rates with a deviation of 1%. Based on all of the stated assumptions, Chino's enterprise value will lie between $240 million and $330 million. Again, we decided to put our hat on the enterprise value derived from the comparable WACC and the industry growth rate. To find the share value for Chino's, we adjust the enterprise value of $285 million to an equity value by subtracting long-term debt and adding cash back in. Dividing the equity value by the 10 million outstanding shares, we conclude to a per share value of $25.94.
If all of this holds true, Chino's value is virtually $26 per share. That is above ATL's offer of $20 per share, and therefore, Chino's should look for other buyers in addition to ATL Capital. But come on, really? Does anybody in this room actually believe that all of this is going to happen? Chino's is currently underperforming its competitors on operating profit margin.
It is also heavily leveraged compared to its peers with a debt-equity ratio of about 3 times.
And it's underperforming industry sales growth.
Also, the possible negative impact of online retail was not accounted for in the first stated industry growth rate.
Online retailers are expanding and a rising popularity with consumers.
Moreover, Mac's new partnership with Southeast has yet to prove that it will add any value to the firm.
Chino's CFO, James Fronter, thinks Quantia's and Mac's forecasts are wrong, and that a decline of sales and EBITDA is more likely.
Not even the board is convinced that Max is the ideal successor of Quantia as CEO.
We considered a potential acquisition of Boots Electric. However, the information provided is too preliminary to estimate the added value. Don't forget the upfront cost that must be incurred to acquire the additional cash flows.
The fast turnaround that Chino's analysts project, we believe, is very unlikely. Going from underperforming the industry with low margins and declining growth to a hockey stick growth?
Well, not one comparable company pulled off what Chino's is projecting. And all these points that you see here are reasons why Chino's forecasts can't be taken at face value and adjustments have to be made.
Let us now go into a little more detail on a handful of the aforementioned points. To search for comparable companies, we pulled a data set of 50 company peers. This scatterplot chart shows Chino's peer group growth trends in revenue over the last 2 years compared to its related EBITDA multiples. For the sample, it seems that the multiples are correlated with the growth trends, and we can see how companies with recent declining growth are trading at lower multiples. Chino's growth trend the last 2 years declined by about 16% annually. So to find a company's position more comparable to Chino's state, we looked in that area of the chart. It is shaded in blue for you. Most of the comparable peers are not trading at multiples higher than 5 here. So management's comparison to companies trading at 8 times EBITDA might be a little too optimistic. The second scatterplot chart shows the peer group operating margin compared to comparable EBITDA multiples. Chino's has had a strong decline on already low margins, and over the last year of operating, it had around 3% operating profit margin on its sales. To then find out what companies trade at with similar margins, we looked in that area shaded. The points are showing what multiples companies with low margins are trading at, and it is harder to tell here whether there is correlation between margins and multiple. The samples are more concentrated around the low margins and the low multiples. We also wanted to share a point shown by the revenue size of the peers compared to the EV/EBITDA multiples. This bar chart shows our sample of peers with the revenue size of the companies compared to the related EBITDA multiples, listed in descending order. And this sample is adjusted for the smallest companies that are trading at extraordinary high multiples. Most likely because they are new companies with potential of growing fast. Chino's position is shown here in red. There is a clear correlation between revenue size and multiples, where the higher revenue companies usually are traded at higher multiples. Hence, we will consider that when we now select comparable companies to derive a market approach valuation. Let us now present you an estimated market value derived from a market approach. Taking the previous notes into consideration and looking at comps for Chino in its present state, we selected 7 companies out of its 50 peers. That could give a better indication of what the company should be valued at. First, we looked for public comps as of the beginning of 2014 in the same industry. Then, we sorted the data set after growth trends and looked in the bottom range regarding previous growth performance. Next, we selected the comps after similar profit margins, turnover ratios, and leverage standpoint. In the end, we also sorted out 2 big and 2 small companies. These are the 7 companies we found to be positioned somewhat closer to Chino's present state. We pulled the EV/EBITDA multiples as it best justifies valuing retail companies. This is because of the assumption this industry is capital intensive and in need of human labor. While none were completely similar to Chino's, they at least back up the same story that we have been told for Chino's. And by averaging the 7 EV/EBITDA multiples, we come up with a multiple of 4.9 and a median multiple of 4.6. Even though the outliers are mostly filtered out, we will use the median value here of this sample as it's more representative of the central tendency. To estimate a market value based on our assumptions of the present state, we ran a market approach valuation. If we multiply the trailing 12-month median multiple of 4.6 from the comps with our trailing EBITDA, we conclude to an estimated enterprise value of $132.7 million. To find the equity value so that we can further compare it and justify the price which Chino's is now trading at, we have to adjust the enterprise value to an equity value. To do that, we deducted long-term debt and add back in the cash and cash equivalents. As we want a value per share, we also divide the equity value by the 10 million shares outstanding and find the per share value to be $10.73. That is less than half the value of the maybe too optimistic forecast we were first told about, and shows no evidence that the high value is being feasible. $10 to $11 per share sound about right given that the stock is trading in not too much higher. Next, we'll look at what we think is more reasonable projections to run a new income approach valuation.
Our income approach valuations are based on the following projections of Chino's financial statement items. The following charts are similar to earlier charts on Chino's own projected values. We have Chino's projection as a line graph and our own projections as a bar chart with the years represented by the x-axis and dollar value in thousands represented by the y-axis. Year 2011 and 2012 are Chino's historical values, while year 2013 to 2019 are our projections. As we mentioned earlier, Chino's projections of industry and sales is way too aggressive, and we do not believe those projections are possible, especially when Chino's CFO too have a hard time believing the projection himself. How can we as an outside source be confident in your numbers when your management aren't confident? We cannot possibly expect that you will outperform the industry in the future after industry has matured and start to decline when you performed way below the industry before, and when there are so many uncertainties on your end about the numbers. As shown on the chart, we used Chino's actual sale of $500 million in 2013 and projected year-to-year future sales in men's retail clothing industry that averages to 3.1% increase from 2014 to 2018. We project a slower long-term growth resulting in 2019 sales of $585 million. We don't believe Chino will have a more aggressive growth than the industry because they underperformed the industry before. By using industry growth that takes online clothing industry into account, we are actually adding a premium into Chino's growth. Our expense projections mirror revenue projection and take into account historical expense ratio. Chino historically spent about 95% of their revenue on cost of goods sold and operating expense. 2019 total cost of goods sold and operating expense is around $695 million. Similarly to revenue, there is a huge variance between our EBITDA projection and Chino's own EBITDA projection. Again, our EBITDA forecast is a lot more conservative than Chino's forecast. This is because we do not believe that Chino will be able to turn around and aggressively increase revenue 4 to 6% per year. We did not find any comparable companies that were able to have a hockey stick turnaround, so we have no basis to believe Chino can do that when Chino underperformed based on their margins. EBITDA is projected to increase from 2013 to 2019 at an average rate of roughly 3% per year to around $45 million in 2019. Our conservative projection of Chino's sale based on current men's retail clothing industry leads to an equally conservative operating margin of around 5% compared to Chino's own projected margin of approximately 7%. In addition to projecting Chino's income statement items, we also projected the balance sheet items in order to effectively calculate free cash flow. Each balance sheet items are projected to mirror sales and expense growth at a weighted average historical ratio. This leads to a free cash flow projection of around $13 million in 2014 to $20 million in 2019. As emphasized earlier, there is no way Chinos will step into all the available platforms such as boots industry and online industry and be able to turn around all at once at such an aggressive rate. Again, we use a traditional discounted cash flow method to value Chino at the beginning of 2014. Our cost of equity takes into account men's retail clothing industry, which is the same as the cost of equity we used previously. The built-up method cost of equity is 16.03% and CAPM cost of equity is 13.78%. And with a cost of debt of 7.39% and tax rate of 34%, we have a WACC of 12.97% using the built-up method cost of equity and WACC of 11.34% using CAPM-based cost of equity. Furthermore, we considered other discounts such as discount for lack of marketability and discount for lack of control. However, we determined that neither one applies. Specifically, a discount for marketability is inappropriate for this analysis because Chinos is publicly traded and thus marketable. Regarding a discount for lack of control, this too is not applicable because ATL Capital is looking to acquire the whole company and take it private. Therefore, a control premium is applicable. However, we believe that premium is baked into the $20 per stock offer from ATL Capital, and adding it again would double count it. In conclusions, we did not apply any additional discounts. As previously mentioned, the industry growth rate is 3.1%, and as pointed out, it is presumptuous to apply industry growth to Chino's growth because they underperformed the industry in the past. And the reality is that men's retail clothing industry will decline because it has reached maturity and stores are starting to step into the e-commerce platform due to shoppers' convenience. As Chinos is currently not utilizing the online business platform, we expect their sales to slow down tremendously to a rate of 0.5% in 2019 and despite an average increase of 3% from 2014 to 2018. We chose the build-up method cost of equity to calculate WACC because we feel it most accurately take into account the higher risk of small companies like Chinos compared to their peers and big industry players. This leads to Chinos' enterprise value of $141 million. Here, we have a matrix showing 3 long-term growth of 0%, 0.5%, and 1%, and 3 discount rates of comps WACC, built-up WACC, and cap M WACC. Our valuation comes to be between $139 million and $168 million. Using the 0.5% long-term growth rate and WACC of 12.97%, Chinos' price per share is $11.58. Using the traditional DCF income approach valuation after taking out their long-term debt of $45 million and adding cash of $19 million back in.
Our third valuation approach is also an income approach, but we used an exit EV/EBITDA multiple instead. Our multiple is based on the comparable company's multiple of 4.6, as shown earlier. Like the traditional DCF valuation, we chose the weighted average cost of capital calculated using the build-up method because of its consideration of risk for small companies. This leads to Chinos' enterprise value of $127 million. Again, we have a matrix with 3 discount rates on the left-hand side and 3 multiples shown above, from lowest on the left to highest on the right. This leads to a valuation between approximately $112 million to $152 million. The EV/EBITDA multiple of 4.6 and WACC of 12.97% leads to a price per share of $10.20 after taking into account Chinos' long-term debt and cash value.
We have taken multiple valuation approaches, a market approach, an income approach, and a hybrid of the two. Naturally, we came up with a range of values. However, even the upper end of the range is significantly below the ATL Capital's offer. But our range of values is extremely close to the current trading price of $12 per share. We believe this further supports our valuation as the market is the market, and its efficiency seems to be holding up. Moreover, we believe that it is very unlikely that Chinos stock will appreciate enough to justify not taking ATL Capital's offer. Specifically, the offer comes with a 60% premium above the market price, and by seeking other buyers, ATL Capital may revisit and lower their offer. Considering management, Juantia's desire to leave the company in good hands, and shareholders requesting a return, we believe that ATL Capital is the good hands that Juantia wants to see the company in, and a 66% return should be satisfactory to shareholders. In conclusion, we believe that ATL Capital's offer is more than fair, and we propose a sale without entertaining other offers. All that is left now is to say thank you to you, the judges, for considering our submission to come to Atlanta, Georgia for the final round of the Business Valuation Challenge in 2018.